On March 19th, 2024, while the world was looking the other way, the global financial system as we know it ended. You were probably distracted. The news cycle was filled with the usual noise, conflicts in Europe and the Middle East, the theater of election cycles, the endless stream of manufactured outrage. It's designed that way. While you were watching the loud explosions on your screen, the real weapon was detonated in complete silence in a quiet press conference in Tokyo. The headline, if you even saw it, was intentionally boring. Bank of Japan ends negative interest rate policy. It sounds like plumbing, a minor technical adjustment that has no bearing on your life. This is a lie. That announcement was not a policy tweak. It was a surrender. It was the quiet confession that one of the largest, most reckless monetary experiments in human history has failed, and now the consequences can no longer be contained. For 17 years, the world's third largest economy was transformed into a kind of financial singularity, a place where money was not just free, but you were paid to borrow it. And this single fact became the secret fuel for everything. The relentless climb of the stock market, the impossible housing prices, the private equity boom, it was all underwritten by a hidden subsidy from Japan. This wasn't an engine of growth. It was a global slush fund, a $2 trillion carry trade that allowed speculators to borrow yen for practically nothing and plow it into higher-yielding assets all over the world. Your world. Now that trade is reversing. The free money is gone, and a tsunami of capital is beginning its long journey home. This isn't a forecast. It's a chain reaction that has already started. And what the mainstream press called a return to normal was actually the pulling of a pin from a grenade that has been sitting on the global economy's floor for almost 2 decades. In this briefing, we will not be looking at the official statements. We will be looking at the plumbing. We will follow the money, because what is coming next will not be televised as a crisis until it is far too late. The first rule of institutional control is to define the narrative. You don't describe reality, you create it. The Bank of Japan's announcement was a masterclass in this art. They declared victory. They told the world they had finally slain the beast of deflation that haunted Japan for 30 years. They spoke of a virtuous cycle between wages and prices, painting a picture of a healthy, resurgent economy where rising paychecks fuel confident spending. This is a beautifully constructed fiction. It's the story they need you to believe because the truth is far more damning. The truth is, they didn't win. The policy was a catastrophic failure and they abandoned it not out of strength but out of desperation. Let's start with their primary claim, achieving 2% inflation. On the surface, it's true, but this is where you have to stop listening to what they say and start auditing the books. There are 2 kinds of inflation and they are not the same. There is the healthy kind, demand pull inflation. This happens when a population is becoming wealthier, more optimistic. They spend, they invest, they build. This organic demand pulls prices up. It's a symptom of economic vitality. This is what the Bank of Japan promised their policy would create. Then there is the toxic kind, cost-push inflation. This is what they actually got. This happens when the cost of essential imports, energy, food, raw materials, skyrockets primarily because your national currency is collapsing. Japanese companies aren't raising prices because of booming demand. They are raising prices because the cost of everything they need to operate has exploded. They are passing their pain onto the consumer. This isn't a sign of wealth. It's a national pay cut. For over 24 consecutive months, real wages in Japan have fallen. Let me repeat that. For 2 straight years, the purchasing power of the average Japanese citizen has declined. Does that sound like a virtuous cycle to you? It's a death spiral. The inflation they engineered is not the cure, it's a symptom of the disease. So if the policy didn't create healthy growth, what did it do for 8 years? It acted as a ventilator for a dying economy. It created a legion of what economists call zombie companies. These are firms that are effectively insolvent. They don't generate enough profit to even cover the interest on their debts. In a normal, functioning economy, they would fail. Their assets would be reallocated to more productive, innovative companies. This is creative destruction. It's how capitalism is supposed to work. But with negative interest rates, these zombies could borrow money for free. They didn't have to innovate, they didn't have to restructure, they didn't have to compete. They just had to breathe. This policy kept tens of thousands of these companies on life support, turning the Japanese economy into a stagnant swamp, while simultaneously crippling the very banking sector that was supposed to fuel a recovery. Banks make money on the spread between what they pay for deposits and what they earn on loans. When that spread is zero or negative, their business model is broken. History teaches us this pattern. When an institution is out of options, its solutions become more dangerous than the original problem. This isn't a new story. It's the story of late-stage empires. The policy wasn't abandoned because it succeeded. It was abandoned because the system was beginning to fracture under the strain. The collapsing yen was making the country poorer by the day, the banking system was becoming unstable, and the public was feeling the pain of inflation without any of the benefits of wage growth. They didn't choose to walk out of the hospital. They were wheeled out on a gurney, moments before the building collapsed, and they called it a victory. To understand what happens next, you have to understand the most powerful and least understood force in modern finance. It's called the yen-carry trade, and for the last 2 decades, it has been the secret lubricant for the entire global asset bubble. The concept is remarkably simple. It's a form of arbitrage. You borrow money in a country with zero or negative interest rates, in a currency you expect to stay weak, the Japanese yen. Then you take that free money, you sell the yen for another currency like the US dollar, and you buy an asset that pays you a higher return. It could be anything. A US Treasury bond paying 5%, a dividend stock, an apartment building in Sydney. You collect the difference, the carry, and as long as the yen doesn't suddenly strengthen, you are printing money out of thin air. Now multiply that simple transaction by trillions of dollars, performed every day by hedge funds, insurance companies, pension funds, and even Japanese retail investors themselves. What you get is the largest single financial flow on the planet. Japan, with its negative interest rate policy, didn't just have a central bank. It became the central bank for the world's speculators. It was the planet's free charging station. When Wall Street needed leverage, it plugged into Tokyo. When a private equity firm wanted to buy another company, the cheapest money was in yen. This wasn't a side effect of their policy. This was the entire point. The Bank of Japan intentionally kept the yen weak to boost its exporters, and the flood of cheap capital leaving the country was the mechanism. So where did it all go? The numbers are staggering. Japanese investors became the largest foreign holders of U.S. government debt, buying over $1.1 trillion worth of treasury bonds. They poured hundreds of billions into Australian government bonds, into European corporate debt, into high-risk, high-yield assets in emerging markets like Brazil and Mexico. This wasn't just passive investing. This flow of capital actively suppressed interest rates everywhere else. It artificially inflated the price of stocks, bonds, and real estate across the Western world. That bull market that seemed to defy gravity for the last decade, it was standing on the shoulders of this hidden subsidy. Think of it like this. The global economy became a massive construction site, building ever taller skyscrapers of asset prices. The yen-carry trade was the free, high-octane fuel being delivered to every single crane, every single day. It allowed for more risk, more leverage, higher prices. It was the silent enabler. And on March 19th, the Bank of Japan didn't just turn off the fuel pump. They announced that all the fuel that had ever been delivered now had to be returned with interest. Every dollar that was borrowed now has to be paid back. To do that, speculators have to sell the assets they bought, the U.S. stocks, the Australian real estate, and buy yen to close out their loans. This is the great unwinding. This is the moment the cranes on the construction site all run out of fuel at the exact same time. It's a controlled demolition where the architects are pretending it's just a routine inspection. This is the point where the abstract world of global finance becomes intensely personal. You might be listening to this from a suburb in Ohio or a city in Florida thinking, what does the Bank of Japan have to do with me? The answer is everything. The end of negative interest rates in Tokyo is a primary driver of why your car loan, your credit card debt, and especially your mortgage are about to become more expensive. This is not a theoretical connection. It is a direct, mechanical, cause and effect relationship. It's the first major domino in the chain reaction. Here is how the transmission mechanism works. For years, Japanese institutions, pension funds, insurance companies, banks were starved for yield at home. A Japanese government bond paid them nothing. So they took their trillions of yen, converted them to dollars, and bought the safest, most liquid asset in the world, U.S. Treasury bonds. As we established, Japan is the largest foreign creditor to the United States government. This massive, consistent demand from Japan acted as a giant anchor, artificially holding down U.S. interest rates for everyone. The U.S. government could borrow more cheaply. Corporations could borrow more cheaply. And those savings were passed on to you in the form of lower mortgage rates. Now the calculus has flipped. With the Bank of Japan raising its policy rate, even a small amount, the return on a domestic Japanese government bond is no longer zero. It's starting to look more attractive, and crucially, it's safer. There's no currency risk. A Japanese pension fund manager's primary duty is to his clients in Osaka, not to the U.S. housing market. So they begin to sell. They sell their holdings of U.S. Treasury bonds to get U.S. dollars. Then they sell those U.S. dollars to buy back Japanese yen. This starts a two-pronged attack on the U.S. financial system. First, and most obviously, when the largest buyer of a product suddenly becomes a seller, the price of that product falls. As Japanese institutions sell U.S. bonds, the price of those bonds goes down. And because of how bonds work, when the price goes down, the yield, the interest rate goes up. This isn't a decision made by the Federal Reserve. It's a decision being forced upon them by the global market. The 30-year fixed mortgage rate in the United States is directly benchmarked to the yield on the 10-year Treasury note. As Japan sells, that yield rises, and your potential mortgage payment rises right along with it. Second, this process creates a massive demand for yen and a massive supply of dollars, which causes the yen to strengthen and the dollar to weaken. This makes the remaining U.S. assets held by Japanese investors worth less in their home currency, incentivizing them to sell even faster to cut their losses. This is the butterfly effect in its purest form. A 0.1% policy adjustment in a boardroom in Tokyo triggers a seismic shift in the funding costs for the entire American economy. They were the silent buyer that kept your mortgage affordable. Now they are the silent seller that will make it unattainable, and they are just getting started. In any systemic crisis, you must always ask the most important question: cui bono? Who benefits? Because chaos is never a vacuum. It is a transfer of wealth and power from the unprepared to the prepared. And this event, portrayed as a domestic Japanese policy decision, was not just anticipated by a certain class of global financial players. It was actively sought. For them, this is not a crisis. It is the payday they have been positioning for years. First, let's follow the most direct money trail. For over a decade, a small but powerful group of mostly American and British hedge funds have been making a bet known as the Widowmaker. They have been shorting Japanese government bonds, or JGBs. This means they were betting that the Bank of Japan's policy of artificially suppressing its own interest rates was unsustainable and would eventually break. For years, they were wrong. They lost money as the BOJ proved it could defy financial gravity longer than they could remain solvent. But they were not wrong in their thesis, only in their timing. Now, the dam has broken. As the BOJ is forced to allow rates to rise, the price of all those old zero-interest bonds collapses. These funds who bet on that collapse are now realizing astronomical profits. They didn't just predict the fire. They bought insurance on a building they knew was flammable. But the private profits are just one layer. The geopolitical dimension is far more significant. Who is the primary economic rival of the United States? China. For years, the United States has struggled to compete with a China that keeps its currency, the yuan, artificially low to boost its exports. Now, look at the chain reaction we've just discussed. The end of Japan's policy forces the yen to strengthen against the dollar. This makes Japanese goods more expensive globally and American goods relatively cheaper. It effectively deputizes Japan to do part of the work in the U.S. trade war against China. It is a strategic realignment of currency values that the U.S. Treasury has been quietly pushing for behind the scenes for years. Is it a coincidence that this move happened at a time of heightened geopolitical tension and a renewed focus on onshoring and rebuilding American manufacturing? From an intelligence perspective, there are no coincidences of this magnitude. The pressure applied to Japan to normalize its policy was not just economic, it was strategic. The United States benefits when its largest Asian ally is forced to strengthen its currency, even if it causes some collateral damage in the global bond markets. They are sacrificing a pawn, global market stability, to gain a better position on the chessboard against their main rival. So while the official narrative is about inflation targets in Tokyo, the unspoken truth is about industrial policy in Ohio and naval power in the South China Sea. The true beneficiaries are not just the hedge funds placing bets. It's the national security apparatus of the United States, which has successfully engineered a major shift in the global currency landscape without having to fire a single shot. We have followed the money as it leaves Japan and wreaks havoc on the world. Now, we must turn our attention back to the epicenter of the crisis, because the Bank of Japan did not just create a problem for the rest of us. In the process of trying to save their economy, they have constructed a perfect, inescapable trap for themselves. This is the final stage of institutional decay, when all available choices lead to ruin. To maintain their policy of zero and negative interest rates for so long, the Bank of Japan was forced to become the buyer of last resort for its own government's debt. When no one else would buy a Japanese government bond, or JGB, that paid nothing, the central bank stepped in and bought it themselves. They did this by printing yen. This policy, known as quantitative easing, was not unique to Japan, but the scale was. The BOJ continued this process relentlessly until they owned over 55% of the entire Japanese government bond market. Let that sink in. The central bank now owns more than half of its own government's debt. It is no longer a central bank. It is the largest, most leveraged, and most dangerous hedge fund in the world. And here is the trap. The assets on their balance sheet, trillions of dollars worth of these bonds, are all priced based on the old, zero-interest rate world. Now that they have been forced to raise rates, even by a fraction of a percent, the market value of every single one of those bonds begins to fall. If they allow rates to rise to a more normal level, say 2 or 3%, the mark-to-market losses on their own balance sheet would be catastrophic. It would render the Bank of Japan itself technically insolvent. They would have negative equity. The institution responsible for the nation's financial stability would itself be bankrupt. So option 1 is to let rates rise to fight inflation and strengthen the yen. This results in self-immolation. The central bank effectively destroys its own balance sheet and that of every commercial bank in the country, which are also forced to mark their bond holdings to market. What is option 2? They can defy the market. They can announce a new policy, yield curve control, and promise to print infinite amounts of yen to buy JGBs and prevent interest rates from rising above a certain cap, say 0.5%. This would save their balance sheet from imploding. But what does it do to the currency? If the rest of the world is raising interest rates to fight inflation, and Japan is promising to print unlimited money, the Japanese yen will collapse, not weaken. Collapse. This would trigger hyperinflation as the cost of all imports, food, energy, everything Japan needs to survive, would go to the moon. This is the doom loop. Let rates rise and you have a deflationary banking collapse. Print money to stop rates from rising and you get a hyperinflationary currency collapse. There is no third option. There is no elegant escape. This is the historical endpoint for every regime that has monetized its debt on this scale. From the Roman Empire clipping its coins to Weimar Germany to modern-day Argentina. The Bank of Japan is not special. It is simply the next major empire to reach the terminal phase of its debt cycle. Their victory, in March, was nothing more than a public relations statement issued from the deck of a sinking ship. This is not a historical event. It is an active threat. The chain reaction is in motion, but it will not unfold overnight. Financial crises move in stages, first a tremor, then a pause, then the tsunami. The tremor happened in March. We are in the pause now. This is the time to stop watching the news and start watching the signals. You don't need a doctorate in economics. You just need to know where to look. Here are the 3 critical dashboards to monitor. They will tell you how close the main wave is. First, the currency market. Specifically, the dollar-yen exchange rate, ticker USDJPY. This is the most important price in the world right now. As long as Japanese institutions are selling their foreign assets and bringing the money home, they are selling dollars and buying yen. This puts downward pressure on this number. Watch the 140 level. If it breaks decisively below that, it means the repatriation is accelerating. Conversely, if the Bank of Japan loses control and is forced into massive money printing, you will see this number explode upwards, past 160, past 170. That would be the signal for the hyperinflationary scenario. This single chart is a fever thermometer for the entire global system. Second, the U.S. bond market. Watch the yield on the U.S. 10-year Treasury note. This is the benchmark for global borrowing costs. As Japan sells its Treasury holdings, this yield will be pushed higher. Ignore the daily noise. Look for a sustained move above 5%. A break above that level would indicate that the largest foreign buyer has not only left the market, but that their selling is beginning to overwhelm all other players. That is the point where the cost of your mortgage, your car loan, and your government's debt enters a new and much more dangerous phase. Third and most subtle, watch for liquidity events. This is the insider term for when the plumbing of the financial system suddenly freezes. It will manifest as a sudden, violent crash in an asset that seems completely unrelated. One day, the market for corporate debt might seize up. Another day, a major hedge fund could unexpectedly collapse. These are not isolated accidents. They are symptoms of the same disease. The withdrawal of the Japanese carry trade is removing the lubricant from the gears of the system. When you hear the words flash crash, funding stress, or counterparty risk on the financial news, know that you are seeing the direct consequence of the decision made in Tokyo. Do not expect a single dramatic moment of collapse like in the movies. That's not how modern crises work. It will be a slow, grinding process of rising costs, increasing volatility, and a series of seemingly contained accidents that erode wealth and stability over time. The official narrative will always be one of calm reassurance, right up until the moment it's too late. They will tell you the system is sound. Your job is to ignore them and watch the data instead. The first tremor has been felt. The real test is whether the foundations can withstand what's coming next. The information has been presented. The connections have been made. What you have just seen is not a prediction of a single inevitable future, but a map of the underlying forces now at play. History shows that systems under this much stress do not bend, they break. And they often break in ways that seem sudden to the uninformed but were perfectly logical to those who were watching the pressure gauges. The signals are there. The patterns are clear. The rest is commentary.